John, when we think about the flow of money at the moment, we get one day risk off, next day risk on, relief rally. But there is something going on in that there seems to be a move to repatriate to dollars. We're seeing money flow into ETFs, pretty much at the shorter end, up to 4-year paper in the US. Are you noticing any kind of flow movement which would correlate that, which would suggest that that's right? We're just seeing this move into 4-year paper out of EM and out of European paper.
Yeah, I mean, those are the sort of flows that are associated with these, times of elevated stresses and money looking for a safe haven. As you say, it's sort of coming in waves, and it's very hard to sort of get a strong feel for exactly how things are evolving. There is obviously a lot of strength behind the US recovery. There's a central bank there which remains resolutely on course to raising interest rates, and by doing that, pushing up yields on some of that shorter dated paper and increasing its appeal. So you can see why the money's going in there. But then in the background, there's all these issues around trade and around the sort of questionable recoveries in other parts of the world. It's very uneven, and it's making investors nervous, but at the same time, they see opportunities because of those different relative growth rates that are occurring.
Yeah, where do you see opportunities then, in amongst all of this, in amongst that? I've got this chart which shows how US stock markets are maybe diverging. We see that interesting to see in this overnight session. We see US futures moving higher, but we don't see Asian equities responding. But in your universe, where might you start to look for opportunities in this trade spat, away from the tensions, finding the oversold assets?
Well, what we're trying to do is effectively that, actually see through the sort of the headlines and try and work out exactly what's going on in the underlying economies. I think if you look, for example, in our world at the sort of the spread between government bond yields is almost unprecedented in a lot of these markets. You have 10-year treasuries almost at 3%, and then you look at core Eurozone bonds in Germany, it's less than 0.5% for 10-year debt. So that difference between the yields is highly unusual. We don't think ultimately that it can be sustained, because it obviously tells you a story about the relative growth rates of those two very large economies being dramatically different, and that won't persist in the long term. So we think that spread ultimately is going to start coming down, probably through higher Eurozone bond yields. So there's opportunities like that, I think, which tell you about the ability to trade these discrepancies between the markets.